Welcome back. It was a fairly steady show from Federal Bank in the fourth quarter as the trend in net interest margins, which was declining, has been arrested. Slippages also has reduced quarter on quarter. 35% of the book, of course, is under moratorium. We learnt that from the press conference. Joining us now is Shyam Srinivasan, Managing Director and CEO of Federal Bank. Good morning, Shyam. Pleasure having you with us. Well, 35% of moratorium is, I think, largely the average if you took private and public sector banks. How would you look at that book? Would you worry that after the moratorium, the slippages could increase there?
Hey, Lata, this is quite hard to tell. All we can say is statistically that number doesn't look way off versus some of the sort of more renowned banks, so to say. So I believe that we just have to see how things come out. It's hard to tell at this juncture, but we've sort of sliced it, diced it through various cuts to get a sense of how much could be the potential risk of it, what can happen, how do we reach out to those customers, what kind of interventions we should do. And again, by the different businesses, right? The retail and the small businesses will have the maximum impact if 3, 4, 5 months cash flows are interrupted. So I would say we'll have a better sense of it only by August, as is obvious. But we've been in close touch. There are some proxy indicators I'm looking at, like how much of the balances that they hold in their accounts are good to serve 1 and 2 EMIs. And it's quite interesting to see that 65-70% of those customers who have deposit relationships with us have at least 1 EMI in the account to serve. So I suspect they're doing this to hold on to cash as opposed to paying. And my guess is by July, if some degree of momentum and business starts, people will pay down because they know that the cost of moratorium is quite high over an extended period of time.
Okay, Shyam, the other thing, we'll come back, time permitting, to asset quality. I wanted to ask you about margins. SBI has cut its deposit rates further. I mean, they are now into external benchmarks, so they would. Does this cast a pressure on you guys as well? Will you be able to do that? Because private banks obviously give higher deposit rates than State Bank. How will the margin picture play out in the coming quarter?
Lata, you've reported it many times. We started the deposits links to external benchmark even before SBI did. So I was the first bank on September 1, 2019 to link my deposits to external benchmark, and we've only grown from then. So I don't see any challenge uniquely different for us versus anybody else. If anything, they followed us.
No, but how will margins shape up? I mean,
you've seen my margins go up. You've seen my margins go up in the last 2 quarters.
So you expect that to continue, you're saying?
Yeah. And I just want to point out, you said margins inched up. Actually, if the full month had normal month, it would have gone up another 4-5 basis points. As you know, the recovery upgrades also help in ensuring that the margins, because to that extent interest income gets positively accreted to. So to that extent, it would have been closer to 307, 308. And I think I did point out on many calls for the Q2, Q3, that was the part which was playing through the T-bill linked book. So as the T-bill linked books sort of runs off, you get back to your run rate of the normal 3% plus margins.
Okay. Shyam, good morning. Is there a risk of provisions going up rather sharply over the next 2 quarters? Because this time, your provisions have been lower. And I take the point that, you would want some time to assess. Nobody knows right now how much of the moratorium book would turn into NPAs. But could provisions shoot up in the second half?
Anuj, Q1, Q2, as you know, would be no or low slippages. So it allows us to start creating an additional buffer in these 2 quarters, which we will do. You've seen us in Q4 take up close to 809 basis points additional cover and build up a buffer. Our coverage ratio with technical write-off is now 73%, probably the all-time high for us. And we'll keep that as the new benchmark and keep building on that. So by the time I think the businesses are fully up and running Q3 onwards, I do believe the slippages will go up. There is no question about it. The level of it we have to see. So we'll create a sufficient cushion and pad to make sure that we can absorb it better. But this is evolving, right? I can't quite predict to the last T how things will play out. As we have been strong in Q4, particularly in operationally, I do believe Q1 should see no major surprises for the fact that there will be no slippages. The known businesses such as gold and others are trending well. Our deposit franchise continues to be strong. So I really think the picture will emerge August, September, by which time we would have created reasonable provision and then sort of look at how things go. Hard to tell, but we'll keep building our reserves, so to say, to make sure that we are reasonably well positioned. You don't know how bad the damage can be, but we will be conservative and provide well to make sure that we can take the hits if they were to come.
Shyam, can you give us some more details or throw some more color on what's happening with the retail book? Because a large chunk of your loan book comes from that segment, and there is an expectation that there could be a second wave of NPAs because of this mass exodus of migrant workers that we've seen. In general, a lot of layoffs, salary cuts, etc., that could hit the salaried part of the loan book as well. Any more details that you can share with us?
Sure. If you've had a chance to look at our deck, we've sort of given by the different business segments what's the moratorium that's been taken. Retail is about 38%. Retail as in the traditional definition of retail, not the regulatory definition. This is home loans, loan against properties, auto loans, personal loans. That's about 14,000 crores of our 33,000 crores is in moratorium. Of that, again, it's there in our investor deck. We've put in a fairly homegrown decision engine to find out using multiple analysis to figure out how bad or how deep it can be. And sort of an emergent portfolio of about 5 to 7% of the retail book is what will come up as the high risk. So you have to apply a PD on it and look at what kind of losses can come. Doesn't look out of range than what we all expect. So I would like to believe that it should not alter the course beyond what we had sort of visualized given the magnitude of the COVID situation. But it's evolving. Like I said, the heartening aspect of that is at least one EMI is available in the accounts for them to service. So I would suspect people who want to, an average retail customer who can manage will try to keep the account standard. But it's not going to be easy for anybody. But retail doesn't, because largely, in fact, our unsecured book is very, very small, right? Over the years, we've been quite conservative. We don't have a credit card product. We don't have a PL book, which is sold to new to bank. So to that extent, the book is largely retail secured. Unless there's a massive fall in this underlying security, we should be okay. Our LGDs have never crossed 45%. And as we take our coverage up to 50 plus, we'll be well provided for.
Okay. Shyam, you didn't observe any dip in deposits.